Welcome to Finance Deep Dive. All right, today we are cracking open the playbook on angel investing. We're going to break down the high-stakes strategy and the hidden rules for anyone who's ever dreamed of funding the next world-changing company. It's the billion-dollar question, right? What's the secret formula? We are going to dig into that exact question using a 5-step playbook to guide us through the entire game. Okay, so here's our game plan broken down into 5 key plays. We'll start with who even gets a seat at the table, and we'll finish with the one single rule you absolutely cannot ignore if you want to win. First up, the angel investor profile. Because before you can even think about placing a bet, you have to know if you're allowed to play. So who gets in? So what exactly is an angel investor? Well, they're not just some walking ATM. These are successful people investing their own money, their personal cash, into brand new companies, and they often become mentors, opening up their networks for the founders. Now, you've probably heard of VCs too. The key difference really boils down to whose money it is and when they invest. Angels use their own money to get in on the ground floor. VCs, they're managing a big fund of other people's money, and they usually come in later when the company is a bit more established. But here's the thing, this isn't a free-for-all. Because investing in startups is super risky, the government, specifically the SEC, has rules about who can participate. It's called the accredited investor rule. To qualify, you have to hit a certain financial bar. Path number 1 is having a net worth of over $1 million. And get this, that's not including the value of your main home. Don't have a cool million sitting around? Well, there's another way in, your income. If you make over $200,000 a year as an individual, or $300,000 with your spouse, and you've done that for the last 2 years, you're in. These rules are there for a reason, to make sure you can afford to take a big loss if an investment goes south. Let's move to play number 2. Okay, so you qualify, fantastic, but now what? How do you actually find these amazing startups? Where do the deals come from? You gotta hunt for them, and honestly, the best deals often come through your own personal and professional network. But you can also find them at pitch competitions, by joining organized angel groups, or these days, by using online platforms like AngelList, which have really opened up the game to more people. Now, these angel groups, they are a huge deal. Why? Because for a founder, taking one big check from a group is so much better than chasing 20 small ones. It results in a much cleaner record of ownership, what's called the cap table, and that makes it way easier to raise more money down the road. Okay, we found a promising deal. Now comes what is, without a doubt, the most critical part of the playbook: due diligence. This is where you look at the founder's hand and check for a bluff before you push your chips into the middle. The best way to think about it is like this. You're a detective. Your job is to investigate everything. You're looking for clues that the story is true, but just as importantly, you're looking for any hidden traps that could sink the whole thing. Your investigation starts with the financials. First, burn rate and runway. How fast are they burning through cash, and how much time do they have left? Then you dive into the core engine of the business. How much does it cost to get a new customer versus how much is that customer worth over time? And right here, this is the magic ratio that every single investor is looking for. For a business model to be healthy, the lifetime value of a customer, the LTV, needs to be at least 3 times the cost to acquire them, which is the CAC. If it's not at least 3 to 1, that's a massive red flag. So when you invest, your money is usually structured in one of 2 ways. The traditional way is a convertible note, which is basically a loan that turns into company stock later. But the new standard, what you see everywhere now, is the safe note. It's way simpler, it's not technically debt, and it's much more friendly to the founders. All right, let's tackle that question from the very beginning. How in the world do you put a price tag on a company that might have 0 revenue, maybe not even a finished product? This is where it becomes more of an art than a science. There are a couple of methods that help get the conversation started. The Berkus method is great for pre-revenue companies. It values them based on the progress they've made. Then there's the scorecard method, which compares the startup to similar companies. Look, neither gives you a perfect number, but they give you a reasonable place to start negotiating. Hey, just a quick pause here. If you're finding this video valuable, do us a favor and hit that subscribe button. Seriously, it helps us a ton and lets us keep making more deep dives like this one for you. Okay, let's get to our final, and I mean this, most important play. If you remember only one thing from this entire video, please make it this. Angel investing is a numbers game, and it's run by one very powerful law. That law is called the power law. Here's the best way to think about it. Imagine you're a farmer, but you're not trying to grow a nice, even field of corn. Nope. You're planting hundreds of different seeds, just hoping that one of them grows into a giant, world record-breaking tree. And here is the brutal reality of that power law in action. Get this. Over half of your investments will probably go to zero. Poof, gone. Another chunk might give you a little bit back, but your entire profit, all of it, will almost certainly come from that tiny 10% of winners, from that one giant tree. So, how do you deal with those odds? How do you give yourself the best possible chance of finding one of those massive winners? It's simple, really. You have to plant enough seeds. The data is very clear on this. A successful angel portfolio needs at least 20 different investments. In this game, diversification isn't just a good idea, it's everything. So at the end of the day, this game is incredibly high risk, it's illiquid, and it's very, very long term. The real question isn't just, can you pick a winner, but do you have the discipline, the capital, and the sheer patience to stay in the game long enough for that power law to actually work? If you enjoyed this video, make sure you subscribe for more.